Welcome you all to the seminar on international taxation. I request Pramod Regde to welcome the speaker onto the dais. And present her with a floral bouquet. I now request Pramod Regde, Vice Chairman of Bangalore branch, to give the welcome address.
Good morning, my esteemed professional colleagues. A warm and personalized welcome to one-day seminar on international taxation organized by Bangalore branch of SIRC. It's truly an honor to have each one of you here. As we navigate the intricate landscape of international taxation, I find myself reflecting on the dynamic nature of our profession and the pivotal role it plays in the global economic arena. Today, our lineup of speakers is not merely a group of experts. They are individuals who bring wealth, experience, and insights that extend beyond the confines of the textbooks. Commencing our day, we have esteemed CA Bhamini, who will lead us through the overview of international taxation with the residential status in the era of increasing connectedness. Understanding the nuances and determining residential status is more critical than it was before. Following this, we have CA GS Prashant, who will share his invaluable expertise on the recent case laws and judgments. It's just not about the cases, it's about the stories behind them, the lessons learned, and the impact they have on our practice. In the afternoon, we have CA S. Krishnan to guide us through the complexities of foreign tax credit. It's just not theory these days, it's about the practical insights that can make a significant difference on a day-to-day work, especially those involved in cross-border transactions. Concluding our seminar, we have CA KL Prashant shedding light on royalty and FTS. It's just not about understanding the regulation, it's about grasping the real-world implication and how we can navigate these challenges. I want to express my heartfelt gratitude to each one of you for gracing with your presence. Our branch and esteemed speakers have curated an event that goes beyond the routine, and your participation adds an immense value. May today's discussion not only enlighten, but also provide a fresh perspective, spark new ideas, and contribute significantly to our professional growth. Before we jump into the retrieving word of international taxation, a quick heads up about our mandatory CPA attendance. Yes, we are just not here for the snacks and the wisdom, we are also here to clock our CPA requirements also. The first session attendance will be taken during the coffee break, and the second one post-lunch, the third during the tea break, and the fourth after the program is concluded. So folks, let's keep it light, let's keep it lively, and most importantly, let's keep track of all those attendance which counts for us. After all the seminars without an attendance is like filing your tax returns without your numbers. So it doesn't just add up. So welcome you for this one-day seminar, and we will deep dive into the seminar today. Thank you.
We shall move on with the inauguration of the seminar by lighting of the lamp. Okay. Let me introduce the first speaker, CA Bhamini GS. She's a practicing chartered accountant with over 12 years of experience. Heads international taxation at Suresh & Co. She specializes in advising on global corporate structures, equalization levy, and resident or non-resident tax implication. Her expertise extends to inbound or outbound transactions, investments, and indirect asset transfers in India. She has presented papers at seminars and co-authored book on international taxation and transfer pricing, showcasing her commitment to advancing knowledge in the field. I welcome you, ma'am. Now we all shall move on to inaugurating the session by lighting the lamp.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः शितः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Now we move on to the session. Over to you, ma'am.
Request members to kindly come forward so that the people who come late can take the last rows. I will request Bhamini ma'am not to ask questions for the front rows. I think please come forward. Over to you, ma'am.
Good morning, everyone. And let's start today's session on overview of international taxation with residential status. So first, I would like to start with what are all the things that are happening in the today's international tax scenario. So we have this BEPS action plans which are much in vogue, and the reason this is because there is a lot of shift from the traditional way of looking at international tax. Traditionally, it was more about residence-based and source-based. Right now, it is slowly shifting to market-based and customer-based. So if you see, there's a lot of influx of digital economy, digital way of doing transactions, and therefore, in this light, there is a lot of planning happening, which is shifting the profits from from the jurisdiction in which it is supposed to be taxed to the jurisdiction where there is less or no taxation. So to overcome this, or to regulate this, or to reduce this, BEPS action plans have been formulated. And as you all know, India is among the forefront in the countries which actually take all these or try to implement these action plans. So we have quite a few action plans which are in force in India. Some of them are country by country reporting, where we see in the transfer pricing, though it is all at ALP, what is happening is there is no nexus, there is no way for anyone to find out what actually is happening in the other country. So by this country by country reporting and master file, there is a lot of exchange of information happening, and also what the global MNC, what they are doing, what functions are carried out in which place, is all getting documented. And this also this helps mainly even the MNCs to know where they should, how should the profits be arrived at, or whether the risks and remuneration go hand in hand. Next is thin capitalization. We have all seen that in the case of capital influx, capital is very minimum, and because there's a payout is as dividends, which are getting taxed at slightly higher rates, ECBs and loans were considered to be more favorable because the rate of tax is quite less, and also it is out of the profits of the company. And there was no way to reduce, or there was no ways to regulate the profits that were being charged to tax. So now there is thin capitalization, which is there in section 94B, which restricts the amount of the interest that can be set off against the profit, or expensed against the profit. Next is equalization levy. Now this is where the digital economy is very robust, and most of us have seen that we buy a lot of products, or we avail services, or we use a lot of platforms. We don't even know where they are a resident of. So in order to tax this, because this doesn't fall under the traditional system of taxing as of now, even with the DTAs in force, it is not in the traditional way of taxing, because there is no human intervention in many of the cases. It is all the platforms, the automated platforms, the automated facility, standard facilities, which is integrated with the services that are performing this. So in order to tax this as a separate category, Finance Act 2016 got in this equalization levy, not as part of Income Tax Act, but as a separate chapter, Chapter 8. And initially it introduced taxation on, or equalization levy on, online advertisement services at 6%. So what is the difference between this and TDS? In TDS, there's a possibility of taking credit by the beneficiary in his resident country, but with equalization levy, that is not the case. So this was a cost to the company. And later on in 2020, there was another layer of equalization levy which came in, which was mainly for the e-commerce operators, non-resident e-commerce operators. Now, what happened was here, the responsibility of deduction was not on the Indian payers, but it was on the non-resident e-commerce operators. So they had to there is a threshold beyond which they will have to comply with this in India. So for an Indian taxpayer, it is not possible to know what is whether the threshold is breached or not to do the deduction. So the compliance was the responsibility, or is the responsibility, of the non-resident e-commerce operator. And next is significant presence concept. Significant presence is very similar to virtual PE. So it taxes based on the users in a particular location, like in India. So this concept has come in equalization levy, as well as Section 9(1), income deemed to accrue or arise in India. But because it is not part of the DTA, I am assuming this is still not enforced as much, especially where DTA is there and where the documents to avail the DTA benefit is already available. Next, we have the multilateral instruments. Now, this multilateral instrument was, so this multilateral instrument was a key development, and India signed this in 2019. And what happens is, with this, there are the minimum standards that are coming in force. in the tax treaties. So this is in addition to the tax treaties, where the tax treaties are covered tax treaties notified by India, the minimum standards of preventing treaty abuse and principal purpose test and simplified limitation of benefits. These are the minimum standards that every country who is notifying or ratifying the document has to follow. So with this, what happens, any treaty benefit now will have to pass through a principal purpose test. That means what is the principle, what is the purpose for which the transaction is undertaken? Is tax benefit or treaty benefit one of the purpose? Then there is a possibility that the treaty may not be applicable. So when we are reading through DTAs, we have to be very sure that this is a covered, whether it is a covered tax treaty or not, and what is India's position on the various action items that are being taken or the articles that are being taken, and how does the other country also, what is their stand. So if there is a match, only there is a change in the DTA. Otherwise, usually whatever is there in the DTA existing as of now will still continue. You might have seen in the income tax portal where you access the DTA text, you might have seen something called as synthesized text. So this synthesized text is nothing but India's position on that DTA plus the other country's position on that DTA, which helps us to get more insight and understand, what is the crux of, what is the purpose behind the transaction that is being undertaken. Then we have the two-pillar solutions. This is to address the challenges arising on the digitalization. This is still going on. It could be effective from maybe 2025. Many countries are already, started changing their or bringing in the amendments in their local taxes to address this. So moving on, we have this. So what is India's position? There are, as I said, there are 15 action plans. And how is India faring in all this is, see, action plan 1, it is already started equalization levy and virtual permanent establishment and significant economic presence. So as I said, equalization levy is a unilateral tax. This will be in force only till a consensus on the two-pillar solutions is brought in by all the countries participating to it. Once that comes into force, equalization levy may have to go because it is a unilateral and it is a temporary arrangement by India. And next you see action plan 2, 3, nothing is, India has not taken any actions. On 3, on interest deductions, we already saw that thin capitalization, which India has adopted, and harmful tax practices, that is on patent box regime, etc. Then preventing treaty abuse, that is action plan 6. So this forms part of the MLI. Like I said, MLI, which is a multilateral instrument which is ratified by India in 2019, effective from April 2020. So as a part of this MLI, whatever the principal purpose test that it undertakes is to see that any treaty benefits, there is no treaty shopping. It has to reduce treaty shopping. So this is the main intention. And there are a lot of articles under the MLI where India's position is either reserved or it has adopted few positions, and it has not adopted few positions. It is silent on few positions. So be very careful when you're going through the DTAs to understand, even like for like a benefit treaty, dividend benefit under the treaty, taxation of dividend. There is a certain criteria that the period of holding, there is a clause on period of holding. So many places India has agreed to this, has adopted this. But you need to also check if the other country has adopted and what would be the repercussions or what would be the implications on the tax deducted. Next is action plan 7, which is permanent establishment. So this also forms part of MLI. This is mainly, they are narrowing down the definitions or the situations under which PE, permanent establishment, is triggered. Many of the cases there is because splitting off of contracts or commissioner and other arrangements. This is all getting regulated through MLI. And 8 to 10 is action plans 8 to 10 is about transfer pricing outcomes 11, 12, India has not taken any action. 13, again, we have seen that CBCR and master file reporting are already in place, and we are all doing it for all the associated enterprises transactions. And there are a lot of penal consequences in case this is not done. And mutual agreement procedure, India has not actually accepted this, but it has told that the MAP proceedings would be available to the resident citizens or residents of the country, and it would be much more faster. The solutions or resolutions would be much more faster. The 15th is the multilateral instrument. So this, together with DTAs, it has to be seen to see the implications. So this is some of the latest things that are happening in the international tax area. Now, let's come back to the routine or to the existing double taxation avoidance agreements. The reason why MLIs was contemplated was because it is very difficult and it is very time consuming for each country to get in touch with the other country, do the negotiations and reach an outcome. It used to take a long time. You would have already seen India, Mauritius. It took about a year or two or more than that to reach a consensus on the grandfathering of capital gains. So this would not be possible because the dynamics are changing, the market dynamics are changing, and the earlier it gets recognized and inculcated in the tax laws, the better it would be for the revenues of all the countries. So now coming back to double taxation avoidance agreements, what are the objectives? It is about prevention of tax evasion, avoiding double taxation, and certainty of tax treatment for the investors, for the people undertaking transactions, and allocation of the tax jurisdiction, which country will tax what and how much, and exchange of information. So this exchange of information has gained a lot of momentum in the recent years because the idea is that globally it has to be seen whether each country in which taxpayer is there, whether all of them are getting their due. That is the whole crux of the BEPS action plans till now. And if you see, one of the objective of DTA was to avoid double taxation. But it so happens that in some cases there is no taxation. There is no taxation at all in any of the countries. So the MLI has tried to an extent to address this, and also the BEPS action plan, that is pillar 1 and pillar 2 will also be definitely addressing this. So this is the overall structure of the double tax avoidance agreements. So first we have Article 1, which talks about the scope of the convention, who are all covered, and 2 talks about taxes covered, who are covered, whether usually the resident of the person should be a resident of at least one of the contracting states, and taxes, what are the taxes that are covered under this DTA. So we have the next 3, 4, 5, which are general definitions. 4 talks about resident, and in the resident, they also talk about tiebreaker. That means if a person is a resident of 2 countries owing to the provisions of the domestic law, then under which country he will be a resident for the purpose of DTA. And accordingly, the taxation and the status, because the status changes, the taxation rules also could change. Next is the permanent establishment, Article 5. So in this, there are physical permanent establishment, that is the fixed place of business, service fees and agency fees are covered under this. Then 6 to 11, we have taxation of various incomes, and 12 to 21, against a lot of incomes, and also based on the person who is undertaking these transactions. Article 22 talks mainly about taxation of capital, and then we have methods of elimination of double taxation, and in what how is the double taxation mitigated, or where is the credit available, how is the credit, what are the whether there is a possibility of credit. This is addressed by methods of elimination of double taxation. Then we have the residuary, that is the special provisions, non-discriminations against the residents, MAP proceedings, how and when, or the entry into a MAP proceeding, the eligibility. And 3031 talks about entry into force and termination of DTAs. Now, having seen the DTA, what we know practically is that, or know generally is that there are three rules for taxation. One is the source rule, one is residence rule, and one is citizenship rule. Now, source rule, we know where the income is arising or accruing. This is the source rule, which is most of the countries follow it, and the residence rule, again, most of the countries follow it. Now, what is the citizenship rule? This rule is that once you are a citizen of a country, then irrespective of where that person goes or where they stay or where they work, they will be taxed in that country based on citizenship rule. So this is, as of now, it is there in United States, USA, and Eritrea. They use this citizenship. Of course, along with this, they will also have the foreign tax credits for the taxes paid in the other countries. Now, we'll come back to our Income Tax Act, which governs or which has some provisions pertaining to residential status, how is it determined, and what is the scope of income for each of these residential statuses, what are the persons, how is their residential status determined. So we have the scope of income provision in Section 5, which says, and I've only taken the income for a non-resident here, so which says that anything which is received or deemed to be received in India or accrues or arises or deemed to accrue or arise in India for a non-resident would be the scope of would form part of the scope of income of a non-resident. Now, Section 6 talks about residential status. So the test of resident or the conditions for which a person becomes a resident is that they have stayed in India. There are two basic conditions, and even if one of them is satisfied, then they become a resident. And for the there is an exception under this, which says that where the person is a citizen of India, where they leave for an employment or they come into India in any previous year on a visit, then the number of days requirement changes. So in case where they leave India for the purpose of employment or as a crew member of an Indian ship, the 60 days, the second basic conditions, first part, 60 days would be, it would be 182 days instead of 60. And a person being a citizen of India or a PIO who comes to India for a visit, in this case it would be 182 days. But if such person has income from India or total income other than income from other sources greater than 15 lakhs, then the number of days would be 120 days. So what do we mean by stay in India? It need not be a continuous stay. It can be the entire year's aggregate would be taken to establish the number of days of stay in India. And some judicial pronouncements have held that the date of departure as well as the date of arrival would be considered in counting the number of days in India. Now, what do we mean by income from other sources, foreign sources? They are which accrue or arise outside India, except where the business is controlled or profession is set up in India, and it is not deemed to accrue or arise in India. So these are two conditions which should be satisfied for income from foreign sources. Next, we have deemed resident. Now, this deemed resident concept came up because there were a lot of issues with stateless persons. What used to happen is they used to arrange their stay in such a manner that they are not a resident of any country. So they were only non-residents of the countries, and they were taxed only on their income which was sourced from that country. So the countries were losing out on the revenue because, as you all know, once you become a resident, your global income is taxed in that country. So to avoid this or to plan around this, the stateless persons used to, have established that they are not a resident of any of the countries. To bring in a way of taxing them or to bring them into a loop of taxation, the deemed resident concept was introduced. So there are three conditions which have to be, and all of them have to be satisfied. That is, they are an Indian citizen, that person is an Indian citizen, Indian income is greater than 15 lakhs during that previous year, and they're not liable to tax in any other country by reason of domicile, residence, or any other criteria. So these three conditions have to be satisfied for a person to become a deemed resident. Now, once what we understand as a resident is once someone becomes a resident, global income is taxed. But here, that is not the case. The tax authorities have given an exception, or they have told that once a person is a deemed resident, they will be a RNOR, that is, resident not ordinary resident in India. And Section 229A defines liable to pay tax as in that country where the income tax liability on such person is there, but it also includes the exemption. So in case the person is liable to be taxed there, but there is an exemption, such person would also be covered under is liable to be taxed to pay tax. So even if they are liable, or even if there is a possibility that they are liable, but there is, due to some exemptions given or some benefit given to such taxpayers, they are not actually paying tax, such persons are also covered here. So next we have the resident not ordinary resident. So once a person becomes a resident under section 6(1), then we go on to check whether they are ordinary resident or not ordinary resident. So for an individual, he has to be a non-resident in any 9 out of 10 years, 10 preceding years. And he should be a non-resident in 729 days, or during the last 7 previous years. Now, for the special category where the non-resident is having an income more than 15 lakhs, in such cases, there is again a carve-out saying that if that person is staying in India for more than 120 days but less than 182 days, then they would still be considered as resident, not ordinary resident. And as we have already seen, deemed resident is already a not ordinary resident. So, and if a person is residential status in respect of any source of income is a resident, so for all the other sources of income, he will be a resident itself. Now let's see some case studies. I've tried to analyze or bring in some case studies. There is a Miss A, who is a citizen of India, and she's gone for employment outside India, and this happened in 22-23. So even after that, she was a resident in her status is a resident in 22-23. In 23-24, she has come on a visit to India for less than 100 days, and she's not liable to tax in country X. Her Indian income is 16 lakhs for FY 23-24. So how do we determine her residential status? So here we first apply the section 6(1) conditions, and there in the second condition, because she is coming to India and she is having income, having income more than 15 lakhs, we apply the explanation B, which says that she is in India for 182 days and her income is more than 15 lakhs. So if we apply the conditions of the second clause C, we see that she is in India for 182 days or more, she is not satisfying that condition, and 365 days or more in preceding 4 years, she is satisfying, so she is a non-resident here. Now, once she is a non-resident, then we go to the section 6(1)A conditions, because 6(1)A starts with notwithstanding anything contained in subsection 1. So irrespective of what is the solution, what is the result there, and the 3 conditions of section 6(1)A get satisfied, that she is an Indian citizen and her income is greater than 15 lakhs and she is not liable to tax in any other country. All these conditions are satisfied, we see here. So she will be a deemed resident and resident and not ordinary resident in India. And her Indian sourced income of 16 lakhs would be liable to tax in India. Then the respective DTAs have to be seen whether she can, if there is any benefit or if there is any tax benefit that she can take from that DTA. And foreign tax credit again would be subject to the domestic laws of that country. Now the same case study, her income is 13 lakhs. So again going step by step to see whether she's a resident first. And we read it with explanation A, because as her Indian income is less than 13 lakhs, the second condition will not be, explanation B will not be required. It's the explanation A which comes into picture, that she is in India for greater than 182 days, which is not, because she is in India for less than 100 days, and 365 days is anyway satisfying. So she is a non-resident. Then again coming to the conditions, this is a double check. It is because anyway one of the conditions is not satisfied, that she doesn't have income greater than 15 lakhs. So anyway that is not satisfied, she will not become a deemed resident. But still she will be she will be a non-resident, and she'll be liable to tax on her Indian income. Now same case study, we have 180 days, she being a resident in India for 180 days. Now directly I'm going to apply the 61A conditions to see, and because 61A does not have anything on the number of days of stay in India. It is the the three requirements are the citizenship of India, and income greater than 15 lakhs, and not liable to tax in any other country. So all these conditions are satisfied, so she'll be a deemed resident and RNOR for that year. Next, we will move on to status of HUF firms and AOPs. HUF or a firm or an association of persons would be a resident of India only if the control and management of its affairs is partially or wholly in India. If it is wholly outside India, then they are a non-resident. Now coming to the RNOR status here, that is in 66B. So where HUF is a resident and the manager or the Karta satisfies the RNOR conditions, then it will be a non-ordinary then if the conditions are satisfied, then there will be a RNOR status. So what do we mean by control and management? So this means where the central control and management and not the day-to-day day-to-day activities of the business. So it means the head or the person who is taking the decisions or where the decisions are taken. This is the control and management that we are talking about, and not just because someone has a right to take manage, or someone has right to take the decisions, does not mean that we see where it is actually taken. So the business may not be done outside India, and it's wholly done from India. So we have to see where exactly it is the control and management exists. Where are the persons who are taking these decisions are there. So this is based on the residential status, what is the scope of income covered under each residential status. And we have seen that income which accrues or arises in India or deemed to accrue or arise is taxed across, for all the status it is taxed. And where the income is accruing outside India but is through a business set up in India, that gets taxed for RNOR also. Next we come to the residential status of a company. So earlier there was a mention that the residential status of a company, an Indian company is always a resident, and a company whose control and management partially in India was a resident. Now they have changed that to place of effective management. So a company whose place of effective management is in India is said to be a company resident in India. So if we go by this, where it's not an Indian company or its place of effective management is not in India, then that company is a non-resident. So we have seen what is this place of effective management, and there are some POEM, this is commonly called as POEM, and there are POEM guidelines which are issued by the board, and which says that if the foreign company's income or gross receipts does not exceed 50 crores in a year, then this POEM provisions will not be applicable. So what does that mean? In case of a foreign company, though it is managed, a place of effective management is in India, but its turnover is less than 50 crores, then it will be a non-resident and it will not be a resident. So place where POEM means effective management, place of effective management. So where the key management and commercial decisions which are required for the business to be undertaken is taken. It's based on substance over form. That means not just in form, just not, suppose a person stays abroad and for the board meetings, but there are no decisions taken there. But the decisions, once he comes back, it is taken on a routine basis. See, one-off cases will not trigger a POEM. It is the holistic, it is the entirety which has to be seen to see if the POEM gets triggered. So it is based on substance over form, where the company, and in the guidelines, they have brought in unique features called as active business outside India. So we'll see what is that in the next slide, where that company is engaged in active business outside India and board meetings are held outside India, then it is presumed that the POEM is outside India, subject to this condition, satisfaction of the condition, substance over form. Again, we cannot just leave it to say that just because the board meetings have happened outside India, there is a POEM. We cannot conclude that. You have to go in depth and see what are the decisions that are actually taken in these board minutes, and what are the crucial decisions, whether those decisions are taken in the board minutes which have happened outside India. Otherwise, there is still a possibility that POEM will get triggered in India if such decisions are likely to be or have been taken in India. So what is the intention behind active business outside India concept? It is for targeting the shell companies or the conduit companies which are created for retaining the income outside India, though the management is in India. And this POEM concept is to be determined on all the relevant facts related to the management and control of the company. And it's not isolated facts. So if one decision is taken in India, it will not trigger a POEM. But if it is done on a regular basis, if such decisions are taken on a regular basis, then there's high risk of POEM being triggered. So again, we have this active business outside India concept. So any companies which fulfill the test of active business of India, outside India, active business outside India, and the board minutes are held outside India, then the POEM is said to be outside India, other than also the condition of substance over form has to be satisfied. What happens if there is no active business outside India? Then the steps are to identify the person who actually makes the management and commercial decisions for the company's business relatively satisfied. That means even if one condition is not satisfied, then that means that the active business outside India concept is not valid. So what are those four conditions? Passive income of such foreign company is 50% of its total income, and 50% of the assets are situated, less than 50% of assets are situated in India, less than 50% of the employees are in India or residents of India, less than 50% of payroll expenditure is incurred for such employees. So even if one condition is not satisfied, the ABOI test fails, and they will not be said to be having an active business outside India. Now again, when we come to passive income, we have seen the passive income of such foreign companies should be less than 50%. Now what is this passive income? This shall be the aggregate of transactions where both the purchase and sale of goods is or from to its associated enterprises, and income by way of royalty, dividend, capital gains, interest, or rental income, or not involving AE. So these both conditions have to be satisfied for passive income. It is the aggregate of these two. So in case there is no active business outside India, then how do we determine the POEM status? Then we go in to see the persons behind the decisions, who is the person who is having the authority to take the decisions, and where they are taken and where they are staying. Are they staying in India and decisions are taken from India, or not. So this has to do with a lot of documentation. Robust documentation has to be maintained. And if they are going outside into those countries where the foreign company is situated, then it is better, or some of them, it is always better to take decisions, go there and conduct the meetings, record the meetings, minute the meetings, and then create a robust documentation. So in case you need to justify it, you need to elaborate it that POEM is not triggered in India, it requires a lot of documentation, a lot of robust documentation, if I can say, to ensure that this, even if there is a trigger, it can be fairly managed. So what are some of the guiding principles on this? Where are the board meetings held? Provided, again, it is not just having a board minute in one place, it is whether the decisions required, the critical management decisions, strategic decisions, whether such decisions are taken in such board minutes. If they are not taken, then location will not have any value. So again, the most important thing in POEM is substance over form. It can be, we can say anything, but if the substance shows different, then there's a high risk of trigger of POEM. And if the board has, again, the board may be a person who is ratifying the decisions which has been taken. So the key authority or the key member who has to take the decision is somewhere else. So the person where such key member resides and whether decisions are taken from such place has to be seen. Then company's head office would be considered to be POEM if all majority conditions are satisfied. Again, substance over form. Virtual meetings. Again, this is becoming very common because of ease of communication, but this also has a drawback to say that in case these are very frequent and this is the person who is actually taking decisions is in India and having virtual meetings, then the POEM gets triggered in India. And generally shareholders' place of residence is not likely to trigger POEM. But if such shareholders or shareholder is a key decision maker or the real decision maker or has the authority to make decisions and which get ratified by the directors in the board meetings, then such key shareholders' place of residence also plays important. So along with what we have seen till now, some more facts, some more additional facts, some more additional situations are a place where the main and substantial activity of the business is carried out and where the accounting records of the company are kept. Now, there are three circulars which have come on this POEM. One of them is that how do we determine the active business outside India and what are the transition between the trigger and the actual enforcement, or what are the compliances required once the POEM is triggered. All these are there in the circulars. Now, what happens if there is a POEM in India? So we know that once the POEM is triggered and POEM is said to be in India, then the foreign company is said to be a resident of India, resident company of India. Though it is a resident of India, but the tax rates at which it is liable is 40%, which is that of a foreign company. And surcharge and cess will be additional. And it will be liable for all compliances which are due to be done in India, like filing of ITR, TDS, returns and deductions and all that. And withholding provisions, like because it's a resident, all that will be applicable. Transfer pricing provisions would be applicable. And in case this is determined at the time of scrutiny and it is established that the POEM was there in India for the earlier years, then interest and penal consequences will be there. Now we have seen what is the residential status as per Income Tax Act. Now we have one more component of DTA. Now DTA, as we saw earlier, there is Article 4 generally talks about the resident, who is a resident of the country and how is the residential status determined and all. So generally the resident of a contracting state is a person who is resident in accordance with the taxation laws of that country. So as per domestic law, if you are a resident, then for the treaty, that is a first trigger. But it so happens that sometimes a person becomes a resident in two countries. So for this, there is something, sub-article 2 talks about tiebreaker test. So these are sequentially done to check where he is more a resident, where can he be said to be a resident, such that his global income will be taxed. So the first one is permanent home available, in which country is it available, and it has been held that rental home is also considered to be a permanent home because he is residing there during the period of service or during the period of stay. Next is where his personal and economic interests are closer, a place of center of vital interest, and so each one, once if in the first stage only if it is decided that his permanent home is at one place and not at the other place, then it stops there. It's not required that all of these have to be seen. Then he'll be a resident of one of the countries. If not, then it will be, it has to be sequentially seen. So next one is, once that the center of vital interest, if it is there in both the countries, then where he has a habitual abode. If that is also in both the countries, then where is a national law? If all these are not, if here, till 4, if it's not decided where he is a resident of, then it will be the competent authorities who have to settle this by mutual agreement. Generally, in the permanent home or in the center of vital interest, we come to know where the person actually becomes a resident of. So, and this is for resident, for individual. For other than individuals, it shall be the state in which the place of effective management is situated. So there may be, it's possible that a company or other person can have a place of management in different countries, but where is it, where do they have place of effective management? That is crucial for deciding the residential status. Yeah, this is about it. Any questions?
Yeah, hi. My name is Anil. Can you please explain the impact of black money law on foreign entity which will be deemed to be a resident in India due to POEM? Will the black money law be applicable and how it will be implemented? How do you go after a foreign entity under these laws?
Sir, sorry, I have not gone into the black money implications, sir, in this. I can look at it and let you know if you can share.
Because this has a serious implication, because if a foreign entity will be treated as a resident in India, then obviously the foreign entity has foreign assets and foreign income, correct, which if it does not offer it for tax or does not file the return, you're going to be covered under the black money law.
Correct.
So that's going to be a serious implication then.
Yes, yes.
Okay.
Thank you. Any other questions?
Just want to see the last clause.
Sir?
The last clause E. If he is a national of both states or of
Sorry.
or of neither
This one, sir?
E
Okay.
or neither of them, the competent authorities of the contracting state shall settle the question. Is there a possibility of giving one example? You have one example in this case where they were not able to decide up to the stage of D, but E was applied.
Practically, we have not seen, sir. That's why I told. Usually, it comes. What we have seen is we have seen till the state of center of vital interest. Usually, there we come to know where he is a resident of, because when they're in employment, they will have their family in a different place. If they have, then usually that place is taken as a center of vital interest. So, coming to the question till mutual agreement, I have practically not seen, sir.
Gotcha. Thank you.
Thank you. habitual about what I can say is, sir, where he is like he has a place where he generally goes back to. It need not be a permanent home, but a place of stay. So that distinction is there.
ಹಲೋ ಬರ್ತಾ ಇದೆಯಾ? ಅದೇ ತಾನೇ ಕೊಟ್ಟಿರೋದು. ನಾನೇನು ಮಾಡಿಲ್ಲ, ಕೊಟ್ಟರೆ ಅಷ್ಟೇ ಕೊಟ್ಟಿರೋದು.
So we have till now seen in the residential status the concept of poem. So there are some ways in which we can mitigate or see if we can mitigate the trigger of a poem. So where the board minutes meetings are held in India, the risk is that the poem is in India. So what can be done is to ensure that or advise on that board meetings to be held outside India, and the critical decisions which are required for the functioning or business of that foreign company taken outside India. Now, what are all the documentations that can be done? One could be the travel itself, when did they travel, and where the place where the board meetings were held, and what decisions were taken. These were all signed off by the persons present, and how these are documented. And if by chance there was a case of having a virtual virtual board meeting, then in the scheme of the entire year or the entire year in which the decisions are taken, how significant this was. It could be just one meeting, but if it has a major impact, which that it's very critical to the functioning of the business, then there is still a possibility that a poem could get triggered in India. And because many times what happens is, because of the virtual access for communication, definitely people or we will not want to keep traveling to conduct these meetings. So here, one way it could be seen that some operational decisions can be taken while they are in India over the virtual meetings, but anything that is critical to the survival or the functioning of the business better be taken outside India. And most important is how this is documented. What are all the ways in which we can provide proof that this actually has been done outside India. And there is also a possibility that in case of virtual meetings, the director who is resident in India may not participate, so that the trigger of poem in India may still be mitigated and not very significant. So, and even in the assume that the company has active business outside India, and majority of board minutes are held outside India, but it is not the board of directors who are the authority, who have the authority of making decisions. They are just ratifying the decisions taken by a key authority or a key person. Then still the poem cannot be said to be outside India, because it is the person, if such person is in India who is taking the decisions, then it will still be in India. So the concept of poem or place of effective management is very, very comprehensive. It is not one day or one situation that has to be seen. It has to be seen throughout. What is the thought in a person's mind when they are taking the decisions, where they are taken? So I can't stress the importance of a robust documentation and ensure that these are happening outside India. What authority the person actually, if there is a foreign director, what authority does that person have? Does that person have the authority to take key decisions, or is it only operational decisions? If it is operational, then it may not be very helpful in addressing the poem issue. It will still be considered as day-to-day operations decisions. And one more thing is, because it's difficult at a point of time to go to a foreign country to take decisions, so it would be better to always know what are all the things that have to be decided on beforehand, so that it is much more effective, because it's practically not possible to go every other week or every other month to a foreign country to take these decisions to ensure that substance over form is met. So it is always advisable to think through this and then establish the documentations. Further, on deemed residents, we know that because there is no number of days of stay and the conditions are slightly different from the regular residential status conditions of stay. Here, what could happen is that just because a person becomes resident of India, deemed resident of India, the question is the DTA benefit still applying to him or not? Because he is resident of India only for a limited purpose, and India has decided not to, generally resident is taxed on the global income. But here India has decided to curtail its right to tax only on the income generated in India and not on his global income. So my view is that DTA benefit or DTA access would still be applicable to apply to such person, and they can still avail the benefit. And how do we establish that if the other country is not taxing such person? The question is not what is the tax amount or whether the payment is made. It is liable to tax, what is seen in deemed resident conditions. So the country should have a right to tax its residents. So how do we know all countries have a right to tax, but how do we demonstrate it? One of them could be a TRC, tax residency certificate, because once a tax residency certificate tells that they are a tax resident of that country. So this is one possible approach to say that he is liable to tax in that country, but because of some specific exemptions or benefits given, there is no actual tax liability to be paid or to be incurred. So here also suggestion is that many of the countries, they have a long process of obtaining TRC. So better to identify these and ensure and also plan the stay in India in such a way, that is beneficial to them. And also the TRC is anyway applicable, so that can be taken to prove that there is no that person is liable to tax in another country, and with that the deemed residency may not be triggered. And in deemed residency, one more point is it is not applicable to a person of Indian origin. It is for a person citizen of India. So there's a difference between these two. That means where they have relinquished the citizenship, again this may still not be, this will not be applicable because one of the conditions is not satisfied. So these are ways, many of the time we lose focus, sometimes we forget, we understand PIO and citizen to be very similar, so there's a possibility that, this may be overlooked. So here, that is one caution, that, PIO is not, he cannot be, the deemed resident concept cannot be triggered for that person. Yeah, I thank each and every one of you for this patient hearing, and thank you, SIRC, for giving me an opportunity to take this session. Thank you.
Thank you, ma'am, for throwing light on the residential status and poem. It was a wonderful session. I request CA Pramod Aragde, Vice Chairman of Bangalore branch, to present a token of appreciation from our end. Those of you who have missed the Code of Ethics mandatory 2-hour sessions can attend the 2-hour sessions at Tumkur tomorrow. For more details, you can visit the Bangalore branch website. We shall break for tea now, and we'll reassemble at 11:40.